So, after the discussion on the deposit schemes and as well as the non-deposit liabilities, we can start the discussion on the some of the other off balance sheet items what the commercial banks always hold. These are also the major sources of income for the commercial banks. The commercial banks also maintain the profitability by using these off balance sheet items, and they also manage the risk by using these off balance sheet items. So, in today's class we will be discussing about certain off balance sheet items, then further we can go ahead with many other off balance sheet items what the commercial banks always use for their risk management and as well as the enhancement of the profitability. Today's class will be discussing about the two things, one is your guarantees and another one the letters of credit. These are the two major items or major off balance sheet items what the commercial banks across the globe always use whenever they try to manage their balance sheet or manage their profitability and liquidity for a particular time period. So, here in this case what exactly the guarantees means or what do you mean by these off balance sheet items, what do you mean by the letter of credit, what are those different types of letter of credit, all kinds of things basically what we are going to discuss today. So, here whenever we talk about the off balance sheet activities, the impact basically if you see the impact of global volatility has increased the variability of the profits in the financial market, and which basically increases the risk of doing the business including the commercial banks. So, the off balance sheet items can be considered as the hedging instruments or can be considered as a instrument which is not purely a banking activity, but still they provide certain services, by that the revenue generation can be made or the profitability can be maintained. So, in this context what basically we can say, the off balance sheet activities are the financial services which is developed in response to increased risk as well as need to satisfy the customer's demand, which can generate stable fee income and increase their capital ratios, which is the measure of the stability. So, first of all the banks are able to maintain the capital ratio by using the off balance sheet items. They can increase their fee income by using these off balance sheet items. They can also able to reduce the risk through the diversification and other risk management process. By that the importance of the off balance sheet items has increased by many folds, but that do not appear in the balance sheet as assets and liabilities. They are basically called as the contingent liabilities or contingent assets, which is not realized yet, but that can be realized. But if it is realized, then they maybe the bank will be exposed to certain amount of risk, but if it is everything goes well, then the bank can generate certain kind of revenue without incurring any kind of specific risk. So, that is the basic objective of the off balance sheet activities. So, that is why the most of the off balance sheet activities are commitments which are based on the contingent claims, and contingent claim means it is an obligation by the bank to provide the funds if a contingency is realized. That means bank has not yet provided any fund, but if there is any kind of, bank is obliged to provide, but if there is a requirement, bank will provide, unless bank will not provide. So, that means it can be realized when there is a default by the party on whose behalf the obligation was written by the bank, and that will trigger then immediate loss or may result in the bank acquiring a substandard claim. So, that basically may happen, may not happen. Because of that, this is not basically considered as a on balance sheet item, this is considered as a off balance sheet item. Claims do not appear on the balance sheet until they are exercised, that is what basically already we have discussed. So, there are various groups of the off balance sheet activities. You have the guarantees, many types of guarantees. We have the derivatives instrument, these are the broad classification you keep in the mind. We have the guarantees, we have the derivatives instrument, we have the other types of balance sheet off-balance sheet activities like trade financing, cash management, insurance services, mutual fund service. There are many other type of investment banking services. So, these are other type of services what the commercial banks can provide, which is called the other off-balance sheet activities. So, in this context, in today's session we will be covering up the certain kind of or most important off-balance sheet activities in today's context what the banks are providing. These are related to the guarantees and some instrument with respect to that, that is basically the letter of credit. So, that is why off-balance sheet items generate the fee income to the bank, transforming the bank's business from being deposit or lending institutions to the risk management institutions, because the services are diversified. Now, the portfolio of the services are quite diversified, which is helping the banks to reduce the risk. But there are certain questions basically raised with respect to that. There are some concerns. How much total risk are banks taking in off-balance sheet activities? What are the different kinds of risk involved whenever the bank goes for the off-balance sheet activities? To what extent should activities should be regulated, whether it should be regulated or not? If it is regulated, then up to what extent this particular regulation should take place? Should reporting requirements for regulators and public be increased? That means, even if it is off-balance sheet item, the bank has to provide the information that how much exposure they have towards this kind of activities. So, whether those kind of things should be there in the bank's side or not, or we should concern about those kind of things or not, that are basically the major questions always we raise ourselves, that how basically this thing can be managed whenever we go for the off-balance sheet activities of the commercial bank. So, whenever we talk about guarantees, what do you mean by the guarantees? The guarantees is basically nothing but a undertaking to stand behind the current obligation of a third party and to carry out that obligation if the third party fails to do so. That means, if somebody has some kind of agreement with somebody, and as a bank I am the guarantor, if that person will not going to exercise or going to oblige that particular thing, then the bank has the duty to act on behalf of that particular person and pay, and as well as or fulfill all those requirements are as per the agreements. For example, if the bank makes a loan guarantee whereby it guarantees the repayment of the loan made from party A to the party B. So, if at any point of time, if the party B fails, the party A fails to pay the money to party B, then the bank's responsibility basically has to fulfill that requirement. So, from the banking perspective, if you see, there is a fee basically bank charges in terms of guarantee, that is basically 10 to 150 basis point, that means 0.1% to 0.1% to 1.5%. That is basically the charge basically they can make, which depends upon the reduction of the borrower's debt cost and the risk exposure of that particular bank. So, the fee basically varies, but the bank charges certain fee against that, but bank is highly exposed to certain kind of credit risk whenever this kind of activities the bank always try to carry out. There are different type of guarantees. The guarantees can be classified into many ways. One is your financial guarantee, we have the performance guarantee, we have the deferred payment guarantee, we have the invocation guarantee. There are 4 major broad types of guarantees the bank can always carry out whenever the guarantees will be considered as a we can say that off-balance sheet activities the commercial banks carry out. Whenever we talk about financial guarantee, when the customer is required to perform financial obligations, mostly it is used in the place of cash deposit on the earnest money. What does it mean? For example, somebody has gone for a tender, somebody has want to do some kind of activity somewhere, and to start or initiate that activities, they have to deposit certain cash or they have to deposit certain earnest money. So, in the place of that, they may not deposit that earnest money or they may not deposit that cash, they can also produce a bank guarantee for that. So, at any point of time, if there is some kind of failure will be there and that person is not able to fulfill that, then it is the bank who has provided that guarantee, that bank will be responsible to provide that services at that particular point of time. So, that is called the financial guarantee. We have the performance guarantee. The performance guarantee will work there when the customer is to perform some task or the work and the bank will pay for the non-performance of the work. So, the one work has been assigned to somebody, any project has been assigned to somebody and within a certain time period the particular work has to be finished, and against that the bank provides a guarantee that if this particular work will not be completed or the particular person is not able to complete the work, then the bank basically will finance that or bank will pay for that non-performance of the work or non-performance of the task. That is basically called the performance guarantee. Then we have the deferred payment guarantee. It is mostly used for the import of the capital goods. So, the amount has to be paid in future installments on agreed terms and the exporter basically requires a guarantee from the importer's bank. Whenever you are buying the big machines or big capital goods for the productions, we are not in a position to repay the money or pay the money at one go. So, if there is an installment basis payment will be made, so in that time the exporter basically always need a guarantee from the importer's bank that the payment will be made in the regular intervals. If at any point of time there is a default, then the money will be paid by the bank only. So, that is basically called the deferred payment guarantees always can possible in the trading process. We have invocation guarantee. Here in this context, the amount basically which claimed under guarantee should be paid to the seller in accordance with the terms and conditions, and payment cannot be withheld at the instance of the customer. What does it mean? If there is a certain kind of agreement and there is a bank is the guarantor, let the particular person who is providing the services or the person from whom the guarantee on behalf the guarantee is designed, let that person will say the money should not be given, because there is some other kind of conflicts between the beneficiary and this particular person who is providing that particular benefits. But in that particular point of time, you cannot stop the payment if there is invocation guarantee, and the bank has to pay that particular money without the consent of the particular customer, even if the customer is not interested to pay that money. Even if they say that the money will not be paid because of so and so reasons, but still the bank cannot stop that particular payment if the particular guarantee is the invocation guarantee. So, this on the basis of the nature of the services or the use of that particular services, the different type of guarantees basically commercial banks provide to carry out the business or to carry out these off balance sheet activities. So, there are certain guidelines with reference to India. If you see, the extent of monetary liability and the period of liability should be specific, that from the beginning that has to be mentioned. The guarantee what the commercial banks provide, that should be issued for a maximum period of 10 years, it should not exceed more than 10 years, and the guarantee should not be issued to those customers who enjoy the credit facility with the other banks. If any customer needs a guarantee from the bank A, but the customer has the credit facility with the bank B, then the bank A is not entitled to provide the guarantee to the that particular customer who is not enjoying or who has not getting any kind of credit facility from the bank A. So, these are the some of the guidelines which the Reserve Bank of India has fixed for providing the guarantee to different type of customers. Then we can go for the letter of credit. So, what is letter of credit? it is also a part of one type of guarantee only. So, this is again an undertaking which is given by the bank on behalf of the purchaser to the seller to make payments of a stated amount on presentation of stipulated documents and the fulfillment of all terms and conditions. So, the letter of credit is again certain kind of undertaking which is given by the bank on behalf of any kind of purchaser to the seller. It is mostly happening in the shipment case or the trading process, whenever we are trying to buy certain commodity from the other countries or other places. In that time, in the domestic economy, whoever is the bank, they provide certain kind of undertaking to that particular seller's bank that the money will not be repaid by this particular entity, then the money will be repaid by them. So, that is on the basis of certain terms and conditions and as well as the certain kind of requirements whatever as per the guidelines. So, it basically facilitates the settlement of the payment of the trade transactions. Mostly the letter of credit is used to facilitate the settlement of the payment of the trade transactions in the market. Whenever there is a letter of credit is designed, a letter of credit is prepared, who are those parties are involved in that? Who are those entities who are involved in that particular process? One is obviously the applicant, we call them the opener of the letter of credit. The buyer who is basically going for this applying or requesting the bank for a letter of credit. Then we have a issuing bank who is there in the particular economy, particular market, or we can call them the opening bank who basically issues this letter of credit. Then there is another party there, we have a beneficiary who is the seller who is providing this particular product to the buyer. Then we have a advising bank who is basically there in the seller's place, and there is a confirming bank who is there also there in the seller's place, there is a negotiating bank, but most of the cases the advising bank, confirming bank and negotiating bank are more or less same. If the bank which is the issuing bank, which is the opening bank, is not that popular bank in the seller's place, then the concept of the negotiating bank, confirming bank, advising bank will comes into the picture. But if the same bank is existing there and the same bank is known to a popular bank which is known to the seller, then more or less these three types of banks are one only. So, these are the different parties of the letter of credit who are basically involved in designing or maybe issuance of the letter of credit in that particular segment. What are those different types of letter of credit? The letter of credits types are many. One is your documents against acceptance, we call the DA, or document against payment, that is called DP. In the case of DA, the documents are released against acceptance of a draft, which is called a term collection, and in the case of the DP, the payments are against the documents on presentation, that is called the side collection. Another type of letter of credit is irrevocable letter of credit. Here the letter of credit cannot be amended without the consent of all the parties. Whatever parties we have, if it is revocable, then actually without the consent of the seller that can be changed, the terms and conditions can be changed. But in this case it cannot be amended without the consent of all the parties who are involved in that particular process. In the context of revocable, already we have discussed that it can be cancelled, can be amended at any time without the prior knowledge of the seller. Without the prior knowledge of the seller. Another one is the confirmed letter of credit, which is nothing but a bank other than the issuing bank guarantees the payment of LC. Issuing bank is not giving the guarantee, some other bank is providing the guarantee to the LC. And transferable letter of credit, if the seller is not the producer of the good. What happens sometimes, we are buying certain product from somewhere, but the person who is selling the product, he is not the producer. So then there is some problem can happen in that particular case, but maybe this particular seller will not pay the producer the money in the appropriate time. So because of that, there is another party involved in that. So that is why the letter of credit can be transferred from the seller's name to the producer name if there is some kind of problem arises between the producers of the product and the sellers of the product. That is why that is called the transferable letter of credit. There are other types of letter of credit also, back to back letter of credit. If one letter of credit is issued against a particular opener or initiator, then again they need another letter of credit that can be also issued. It is basically as a security, the LC is used as a security for the second LC, and the validity basically coincides with the validity of the original letter of credit. The validity period will not be changed, the validity period will be coinciding with the original letter of credit. Then we have anticipatory letter of credit, that is the pre-shipment shipment credit to the seller for processing or packaging. Generally what happens that sometimes seller needs some money because they want to, already the production is made, but they want certain money for processing and packaging of that particular product. So then also some kind of letter of credit can be issued against that, that is called the red clause. So in the agreement, letter of credit is written in the red color, that is why it is called the red clause. And or sometimes the advance can be given to a point with pre-shipment credit, maybe apart from the pre-shipment credit, some extra money also can be paid to them because of certain terms and conditions, with certain terms and conditions, that is called the green clause, that will be written in the green color. So that is called the anticipatory letter of credit. Then we have revolving letter of credit. The revolving letter of credit is issued for specified limit of account, it cannot exceed a particular amount. So that can be always considered from the beginning. Then we have the deferred payment letter of credit. Here in the case of deferred payment, the issuing bank make payments to the seller in installments within the predetermined period and buyer pays later. The deferred payment credit, bank first pays to the seller in the installment basis, and the buyer basically pays to the bank later with certain kind of interest. Then we have a standby letter of credit, mostly it is used in the US market to provide the guarantee for the financial payments. The standby letter of credit is used in the lieu of the bank guarantee, and it is used to guarantee the financial payments which is happening in the US context. So, if you see this, then what basically we have seen that there are certain documents which is required for the letter of credit or to make a letter of credit. We need a bill of exchange between the two parties. We want an invoice which is given by the seller to the buyer. We need some transfer document, legal document which is this particular transactions is legally valid, and the business or the instrument what they are basically providing, these are the legal instruments which is not banned or which is not basically is following certain kind of conditions or rules and regulations followed in that particular country. The insurance of that particular product, because product is shipped to the sea and other things. So, that is why it should be properly insured, the insurance document that has to be proper. The certificate of origin from where the product is coming, and also the certificate from the health authorities, that is this product is not hazardous, and all kinds of documents which is basically should be there whenever the letter of credit will be issued. As per RBI guidelines, the bank should issue the letter of credit to those who has enjoyed the credit facility with that bank. Who already has the credit facility with the bank, the letter of credit can also be issued to them, because the past experience with those customers may be good and there is less risk exposure towards the issuance of the letter of credit to them. So, this is about the documents or the guidelines, simple guidelines which is followed by the commercial bank whenever they provide the letter of credit to the different type of customers. Now, we are coming back to a specific letter of credit, that is which is mostly used for the financial transactions in US. Here the standby letter of credit basically is nothing but it is obligate the bank to pay the beneficiary if the account party defaults on a financial obligation or performance contract. There are two types of standby letter of credits we observe. One is a financial letter of credit and a performance letter of credit, which is again synonymous to the overall letter of credit classifications. The financial letter of credit is related to the financial commitments such as repayment of the commercial paper, and a performance standby letter of credit is non-financial in nature. For example, a commitment to complete a construction project or deliver a certain merchandise and all these things. And banks earn some fee income on providing this kind of services to the different kind of customers at the time of requirement. For issuance of the debt, if you want to use this standby letter of credit, how it is used? It can be used for issuance of the debt obligations like bonds, notes and commercial papers as backup lines of the credit, to ensure the delivery of merchandise, performance of options or future contract, and to back other loans, even guarantee the alimony and the child support payments using this particular concept. So, if you see this example, suppose a city XYZ issues 5 million bond with 7 years maturity to fund pollution control, then to be repaid by payments received by city from project users. So, if the payments are not sufficient to cover the interest and principal payment receipts, then bonds basically backed by the irrevocable letter of credit from the ABC bank will be used for that. Then building contractors obligation to complete a construction project. If the project not completed before the stated date, bank required to pay the beneficiary, and reason for incompletion of the project is irrelevant, and here the standby letter of credit as substitute for the surety of the bond. In the standby letter of credit case, the evaluation is always done in the same way, whatever way the commercial loans are evaluated. Since the banks accept only the credits that they believe are less likely to be defaulted, then the credit risk will be minimal. That is why the same approach they follow. Many standby letter of credits are backed by the deposits or the collateral of the buyer or maybe the initiator, and the long term tenure of commitments can cause risk to change over time. Periodic renegotiation of the standby letter of credit is also sometimes required because of the fluctuations of the pricing of the different assets which is used as the collateral. So, in the event of takedown, banks may book the unreimbursed balance as the commercial loan. That also is possible whenever the letter of credit is issued for some specific reasons. There are many risks involved whenever the letter of credits are issued. A liquidity risk, already we know that this is nothing but the funding risk. We have capital risk which can arise due to losses in terms of the slowdown of the economy or the default of the borrower at the same point of time. Interest rate risk, it is due to the possible changes in the duration gap or increase or decrease likelihood of default in interest rate levels or in the market. Legal risk, there may be some kind of legal risk which may arise in between. Material adverse change clause enables banks to withdraw from commitments under certain conditions, which is happening in US. Clause related to deter banks from taking excessive risk and exploiting banks guarantee. In the same way, whatever way our Reserve Bank of India has imposed certain restrictions to avoid certain kind of excessive loss in terms of the defaults which may happen with respect to this letter of credit business. The pricing of this, they have upfront or the annual fees they pay to get that kind of services from them, and mostly the annual fees on the standby letter of credits are lower than the loan fees in the part due to the lower administrative cost, in other expenses, because normally no funding is required. Virtually no funding is made in the beginning, and that is why we are not incurring any cost for that. That is why the fee is less, but there is excess risk involved in that if there is some kind of default arises from the initiator point of view. So, this is the way the pricing is made for the letter of credit case. So, what we have basically discussed in today's session, the off balance sheet activities are the financial services which is basically developed in response to increased risk as well as need to satisfy the customer's demand, and it generates stable income and increase their capital ratio. Guarantee is a undertaking which the bank always provide to stand behind the current obligations of a third party and to carry out that obligation if the third party fails to do so. And there are various types of guarantees, already we have discussed that part. Letter of credit is also one type of guarantee which is undertaking which is given by the bank on behalf of the purchaser to the seller to make the payment of a stated amount on presentation of stipulated documents and fulfillment of all the terms and conditions. And there are many types of letter of credit always we use for different purposes, and on the basis of the nature of the utility of that particular business or particular purpose for whom these particular credits are issued or letter of credits are issued. So, this is the way basically the guarantees and letter of credit works as a off balance sheet item for the commercial bank. Then we will be discussing about the other kind of off balance sheet items in the forthcoming classes. These are the references what you can go through for this particular topic. Thank you.